What's up, guys? Welcome back. So I wrote this article in March of 2022 on how to retire with selling put options. Forget the FIRE movement, make $70,000 off of $110,000. Okay, so in a really short summary, the idea was to collect premiums on companies that I wouldn't mind owning and collect more premium upfront by selling or writing put options far out or a year out. This, in theory, would help hedge against market downside because number one, if assigned, you're getting stocks of a company for much cheaper with all the premium that you collect. Number two, there's a lot more time before expiration for the market to recover. And number three, even if assigned, you still own shares of the stock and you can essentially hold on to the stock or sell covered calls for premium on the upside. Okay, so if you have no idea what I just said or the basics of options, or you're completely lost, you can simply read my article in the link below. From April 2022, the market has tanked. In fact, the market as a whole has gone down about 27% year to date. We've experienced a market crash, a recession, quantitative tightening, inflation, Federal Jerome Powell moving markets with just a few words, and everything in between. So the first question that I get asked a lot is, how am I doing? Overall, like most other investors, not doing that well. My brokerage account is down about 15 to 20% year to date. The majority is still in unrealized losses, but still, some positions I had to take a realized loss on, and it really didn't feel good at all. On the bright side though, I was heavily invested in oil and gas and commodities that actually performed pretty well during the market downturn. So I closed a number of positions for a nice profit. Now the positions I closed out for realized losses were mostly fintech. Companies like Affirm, Upstart, and some banks and financial companies like Fidelity National Financials. I just personally didn't see a clear tunnel out of this recession for namely the fintech companies, so I didn't really want to hold on to them. On top of that, my Bitcoin miners took a huge hit, like Hut 8 and Marathon Digital Holdings. I broke even on my Tesla put option that I wrote. I closed it out without a loss or profit because I just really couldn't stomach the volatility on a position that utilized $60,000 of buying power on my brokerage account. Now, a number of positions I still hold on to and really isn't expiring until 2023. I closed out of most of my 2024 positions because it was simply using up too much cash collateral. Overall, I'm super grateful that I was still relatively conservative and I didn't oversell these put options. Now, at a few points in June, I actually had to put in more cash into my brokerage account so my brokerage wouldn't start liquidating my positions. But I never used, and I still haven't used any margin at all. So what did I learn and what would I change looking back? One thing I'm really grateful for is I put my money where my mouth was. The article I wrote wasn't just some hypothetical. I actually executed the strategy that I wrote. And as such, I believe that really gave me an invaluable learning experience. Hypotheticals or paper trading aren't bad, but in my opinion, they don't really teach you the reality of the mental distress that one goes through, seeing how much of volatility the market shakes the money you've worked so hard for. And so with that being said, here are 3 invaluable lessons that I've learned this year from this almost black swan event year and market crash. And this is what I believe will make me a better investor moving forward. Number 1 is always hold cash. Okay, so I see articles and videos all the time talking about how cash is trash. And given how high inflation has been, it totally makes sense how if you hold cash, you're essentially losing 8 to 9% every year of its intrinsic value due to inflation. But if you're an investor, cash is super crucial, especially in market downturns that presents to you a gold mine of buying opportunities. This is when you want to buy heavily or double down on the positions that you have highest convictions for. Because shares of the companies that will make you wealthy one day are on clearance, and you want to pick up as much shares as you can during market downturns. How much cash investors should have is entirely up to you, but for me, I generally want to hold around 20% in cash when the market is risk on or bullish, and less than 10% if the market is risk off or bearish. So in other words, I want to be a buyer during market downturns. Number 2 is don't over diversify. With writing put options or selling insurance on stocks, it's so easy and tempting to find a lot of great companies with high premiums on selling put options. And I really believe this was my biggest mistake. I must have found over 70 plus companies that looked absolutely amazing. It was trading at a relatively low valuation, had solid balance sheets, and were companies I simply wouldn't mind owning. So I sold put options on probably 40 or 50 companies and opened just 1 or 2 contracts on each company. And this was my biggest mistake. Because the reality is, you really can't follow 40 or 50 companies that closely, much less double down or invest more money when the market is falling. And if you're selling options, a lot of your cash will also be tied up. So in a market downturn, your buying power goes down a lot more quickly than you think. If I could do it all over again or moving forward, I would cut my positions down to less than 20 companies, possibly even 15 companies. Number 3 is only invest in your true high conviction companies. So I have to confess, I actually did minimal research on some companies that paid really nice premiums. I figured it just reduces the risk because then I could get in on the stock for even cheaper. But to make matters worse, I invested less on just buying shares of companies I believed in, especially if the stock did not pay nice premiums for selling or writing put options on the stock. Now this is very correlated to number 2, and that is to really stick with 10 or 15 of your highest conviction companies. In a market downturn, having cash and 10 to 15 high conviction positions will make it easy to know where to double down or buy more heavily into. Better yet, if one of those high conviction stocks is down a lot, it would make a lot more sense for me to sell or write put options with a closer expiration date on those stocks to make income on good companies that are already down. Number 4 is probably the most important lesson I learned, and that is wealth is a mindset. Okay, so let me try and unpack this. The one thing this crazy volatile 2022 stock market crash has taught me this past year is how much money influences us. Waking up and seeing your account lose 15,000 plus in a day is, in the best way I can describe it, traumatic. Especially if you're like me and you come from very humble or poor beginnings, where $15,000 was once a dream to even have in my account. And even though you tell yourself to just hold and it'll eventually recover, seeing your account drop by months of salary in just one single day just does things to your mind. And I believe that's the reason why many retailers eventually cave in and jump out of the market at the worst possible times to sell. Because institutions and hedge funds have the power to manipulate the market with big money, and they do precisely that to squeeze out retail investors. They do it on any sentiment of negative news. Investing is largely a mental game. You have to hold strong on your convictions. In order to have those convictions, you need to put in the work and do your homework. But the most important lesson I learned so far this year from this wild market crash is that wealth is a mindset that you can control. And it stems from what you believe of money. Now, everyone will have slightly different beliefs about money, but for me, as useful as money is in creating opportunities, buying the things you want, and feeling secure, money is at the end of the day just a tool. When you face the reality of death, sickness, even broken relationships, suddenly money and material things just aren't really that important anymore. For me personally this year, experiencing all those things near and close to me has actually helped free my mind from seeing wealth as the end of all things. It's freed my mind to invest more of my energy and time to spend more time enjoying the simple joys of life, like a simple walk outside or not having to work all the time, and instead spending time with those I love and those who love me. Warren Buffett, the third richest man in the world, said this: basically, when you get to my age, you'll really measure your success in life by how many of the people you want to have love you actually do love you. And that's the ultimate test of how you have lived your life. The trouble with love, though, is that you can't buy it. But the only way to get love is to be lovable. It's very irritating if you have a lot of money. You like to think that you can write a check. I'll buy $1 million worth of love. But it doesn't work that way. The more you give love away, the more you get. You know, I personally don't believe you have to reach 90 years old to measure your success in life by the way you've loved others and are loved by others. Now, will I still work hard and invest my money? Absolutely. But in some odd way, experiencing loss this year has actually opened my hands even more to receive something far more invaluable than money. And that is to love and to be loved by those around me. If you guys like this content, make sure to like and subscribe for more. Thank you so much for watching, and we'll see you in the next video.